Good afternoon, everyone. Thanks for this opportunity. I know it's a Sunday afternoon. Everyone has, lot of objectives, being with their family, going out and watching Pushpa 2, if at all someone is interested. But let me bring focus back to the presentation, and I will try to, make it very simple. Before I start the presentation, I am sure that this audience is mainly MFDs, distributors. They meet clients every day. एक सिंपल सा सवाल, when you go to clients, सबसे पहले आपको क्या पूछते हैं? Return, right? Have you met clients who ask you how you manage risk or only returns? Right? So in my career of 20 years and 8 years as fund manager on the PMS side, I have never come across any client who says, how you manage risk. Everyone is interested in return कितना दोगे, कितना compound करोगे, कब मेरा पैसा double होगा, right? So I will shift focus today not on returns, but how we manage risk at PGIM Alternates. Because I believe one part of the equation is solved, which is return, which everyone is focusing on. But the equally important aspect for investing, at least as a fund manager, is how you manage risk, right? So this whole presentation is around that aspect. So basically, as my earlier colleague also said about, screening the stocks. So what we do is we start with 1,000 crores as market cap, given the liquidity, given where the markets are. And we divide it into two components. The first component being 3,200 to 15,000 crore market cap, which is roughly around 450 stocks currently in India. The second is the micro cap, which is a very interesting space, which is around 1,000 crores to 3,200 crores. There we have almost 500 companies, right? So as I was saying, for any fund manager, there are three aspects. One is safety, which is a risk management. Today you will see me speaking a lot on the safety aspect. The second is growth, because India is a growth economy. Everyone talks about growth. And third, obviously, we can't have a blind eye towards valuation, right? So every stock is good at a particular valuation. We can't be chasing momentum. So let's see what we say by, safety. So I'll give you a very simple example. Today at PGIM Alternates, what we do is, we look at the last 10 years history of a company. Why 10 years? Because out of 10 years, at least every company will go through two down cycles, right? Any businesses you are there, whether it's a FMCG, auto, cap goods companies, everyone will go through a down cycle. And over a 10-year period, at least every company has gone through two down cycles. So if a company is able to maintain a decent return ratio, which is return on equity and return on capital employed, it gives you a lot of confidence on what the company has achieved in the past. So we are of the camp that history teaches you a lot. Obviously, we as analysts do a lot of projections, but we firmly believe once you go through the history of the company, and a company which has survived at least two down cycles and has reported anywhere between 15-20% ROE, ROC, becomes a good starting point for investment from our point of view. The next is, we have seen 2008, we have seen 2012, we have seen 2018. Any company which is over leveraged, they don't survive, given the fact that, again, just an example, I remember in 2012 or not, many of the cyclical companies like commercial vehicle, I will not name the companies, but a lot of companies in auto which were towards commercial vehicles had a huge debt on their books, where the interest outgo was equivalent to the EBITDA or the operating profit, right? So there we have been taught that, okay, debt is good to a certain extent. But if you go beyond, at PGIM Alternates, we don't go beyond 2:1 net debt to equity, because we believe 2:1 could be managed depending on where you are in terms of sector, where you are in terms of your standing. But beyond 2:1 debt equity will be a challenging task, specifically when you have an interest rate environment which is going up. Look at what is happening in US, right? Today interest rates are up, the 10-year bond is closing to 4.5%. India, RBI has done a good job. We are still at 6.5–7%. But any company which is overburdened with debt, if there is a cyclical downturn, the survival will be a question mark for us, right? So we are very cognizant that net debt to equity also has to be within a particular framework. And lastly is the cash conversion. When I say cash conversion, what I'm meaning is the operating profit, जो company operating profit कमाता है, उसमें से कितना cash flow generate करता है. So when I say OCF, I am talking about operating cash flow. I am not talking about free cash flow. Operating cash flow, the conversion of EBITDA into operating cash flow becomes a very important tool. Now I will give you some examples. What we do for screening our companies, right? This comes under safety net, which I was talking about, the risk management. If you look at last 5 years, or if you look at last 10 years, 60% of the time, the company should be able to generate positive operating cash flow. For the benefit of the audience, how we define operating cash flow is basically your profit after tax plus depreciation minus the working capital requirement, right? So if the company is able to generate operating cash flow positive 6 out of 10 years, or let's say 3 out of 5 years, it gives us a lot of confidence on the business strength the company has. Apart from that, the promoter history, right? So if I do the 3-4 parameters, if I pounce on my overall, the screening, I am left with only 150 companies. So out of 950 companies which we started our discussion with, we are left with only 15% of the companies which come under this kind of criteria. Now to give you some examples, right? This is pre-cleanup, before our parameters were mentioned, and post when we did our cash flow analysis and when we looked at the net debt to equity. Look at the screen below, the micro cap investing, right? The companies which are delivering 9% weighted average, ROCE after cleanup. Once you look at cash flows, once you look at the history of the company, the ROCE for that 60, 70 odd companies has gone to 29.4%. Similarly, ROE, again, similar parameter, that 10% has gone to 25% in FY24. So the point I'm making is, if you have the safety net, where you have cash flows, you have cash flow conversion, you have lower debt, and a decent growth profile, you will do better for investors, right? I'll give you a simple example. Today, in a lot of our strategies at PGIM Alternates, the beauty is in the downward market, when the market is very volatile or it's going through a difficult phase, 70% of the time we have been able to generate alpha, or we have been able to protect the capital. This is the reason behind it. So we are not doing any rocket science, but the cash flow itself, which is history and which is past, that gives us a lot of confidence in terms of managing risk. And you are veterans here. When I talk to you, I know you have been speaking to investors and all. A client or a fund which does a decent job in a downward market, I'm sure with their research, with their experience, and with their stock picking ability, if they are able to maintain certain limits in terms of drawdowns, in a bull market they will do wonderfully well. And that's absolutely what we have done over the last 5 to 6 years. Again, net debt to equity, majority of our companies in our portfolios are zero debt, or they have huge cash flows. So net debt to equity is hardly anything here. And as I told you, OCF to EBITDA. So if you look at today, majority of the companies, 60% of our EBITDA is getting converted into cash flows. Now this was about selection, right? This was about parameters which we use and how we protect the downside. Now what is the framework we use for selecting the stocks in terms of growth profile? So this is a proprietary framework which is known as EDGE. E stands for expansion. Again, just to give you an example, we all have been gung-ho about CAPEX cycle over the last 2 to 3 years. How we define CAPEX, and I will give you a very simple anecdotal evidence. Lot of companies in our portfolio, 3 years back, when we started looking at these companies, right, they had increased their gross block by almost 2x or 3x, right? So they have already put up capacity, they had already invested, but their utilization in terms of the new capacity which was coming in was quite low. So once you see a gross block improvement, which is E, expanding capital, once you see the incremental gross block coming in, and you see the utilization of capacity being lower, the moment that capacity utilization starts going up, it's an operating leverage at play. Because earlier your capacity utilization was sub 20%, the moment you get new orders, you start functioning, it goes to 50, 60, 70%, and there, because your cost is fixed, you have an operating leverage at play where the moment your top line comes in, automatically your margins also start improving. So the biggest benefit in terms of growth investing at PGIM Alternates is we look at gross block, we look at expanding capacity, and because these are current new capacities coming on stream, the moment the utilization gets improved, you see margins also coming back to the companies, right? So it's a double whammy. You have revenues coming in, because of the fixed cost structure, you have earnings coming in, and hence market also is cognizant of the fact that this company is growing faster than what the top line of the company is growing, and that's what gross block or expansion alludes to. Second, as I told you, I will not spend much time here, disciplined leverage, right? Majority companies continue to be debt free. The third is generating positive operating cash flow. Again, I have touched on it. And the fourth is bottom of the cycle, right? Now, a lot of sectors like chemicals, like textiles, we have seen cyclicality built into these sectors, right? As a fund manager, it becomes very difficult for us to, time it that, okay, now we are near the bottom of the cycle. But the moment you see that cash flows are intact, balance sheet is intact, promoters doing the right things, it's a matter of time, then cycle will improve. So let's say, for example, today, last 1 year, chemicals have not done well, right? You have seen a lot of chemical companies, their revenues are going down, their margins are going down, the stocks also have underperformed. But now, the moment you see last 2 quarters, some semblance in terms of revenue coming in, new orders coming in, margins stabilizing, you get a sense that, okay, we are near the bottom of the cycle, and hence you are getting the valuations where they are. So once you have this operating leverage, operating cash flow, debt equity, and capex cycle which is behind you, you can make tons of money in these kind of cyclical stocks. And that is what we believe in our micro-cap investing. So this was about the risk management, right? We did the safety net. What after that? It's very easy for a fund manager today to get into a stock and recommend you a stock and say that, I think this has a beautiful future, it will compound at 20-30%. But a litmus test for our fund managers is when you exit. Again, just to give you a simple example at PGIM Alternates, what we do is, we have a PEG framework. What is PEG in a very simple terms? We look at 1 year forward PE ratio, which is price to earning ratio, and we'll look at the next 2 years earnings CAGR, right? So when you divide 1 year forward PE multiple of a particular stock with the earnings CAGR of that particular company, that's your PEG ratio. Normally, as a process, it is not 100% true, but almost 70-80% of our portfolio construction is based on a PEG of 1 to 1.5. So if you get a stock, let's say it's trading at 20 times, and it's compounding earnings at 20%, right? So the PEG ratio is 1. So that gives us a good entry point for our investors. So this is a very easy part to do it. The litmus test for us is, when do you exit, right? In today's market, I mean, it's very easy to get carried away with momentum. It's very easy to, if you have made 50%, you will think that it will go 100%, I will not sell the stock. But as a framework, as a discipline, what we do normally is, the moment a PG ratio of our stock goes beyond 3 times, which is, let's say a company is trading at 60 times 1 year forward, and the earnings growth is only 15%, which is 60 by 15, which is 4 times. It's a red flag for us. So what we do is, let's say today we have a 10% allocation to that particular stock. It has done wonders for us, but the PEG now goes beyond 3 times. The first thing we do is, we cut down on our position there. We'll make it half, right? And eventually, if it goes beyond that, we will exit the portfolio, exit that stock, and look at some other opportunities. Because believe me, in investing, risk management becomes a very important criteria, which unfortunately no one talks about. So if you have the framework of the safety net, which I explained, apart from that, we are all growth investors. We look at growth, that goes without saying. But if you have this PG framework, entry is fine. Exiting the stock, when to exit the stock and when to take profits off the table is equally important in our assessment. So, and one more thing which is very peculiar about us is what we have avoided in last 5 to 6 years, right? We have avoided financial leverage. So today, if you look at, and you can talk to my team later on, if you look at our 3 schemes in PMS and 2 schemes in AIF, we are one of the few fund managers in alternate space who have been underweight financials, right? So throughout last 5 years, we have been underweight financials because it's financial leverage, right? And on a very lighter note, right? Today, agar market gilta hai, the first sector which gets impacted is financials, simply because it's linked to your economy, right? So unless and until you see a great value in terms of, the growth coming in and the valuations which they are stacked up, so we are not zero financials, but if you look at our history, we have been quite underweight financials. That's one more reason why across all our 5 portfolios, the beta of our portfolio is 0.7. You guys understand beta. Obviously, if you don't have financials in your portfolio, your beta will be definitely less than 1. Plus, because you have cash-rich companies, debt-free companies, your beta will be lower than 1, right? So, we are quite confident that 2 things matter for us. 1, beta is lower. Second, our Sharpe ratio, which is return per unit of risk. Higher the Sharpe ratio, better is the return per unit of risk. There, we have scored higher. So, compared to broader markets, our Sharpe ratio is better, our beta is lower. So it's a very good balancing act between not taking undue risk in terms of building the portfolio. At the same time, in an upturn market, you participate in terms of the upside for the investors. One more thing on the growth part, which I would like to say is, today we all know, first half of this fiscal, right? Nifty 500 earnings have been 5% or maybe 5.5% for the first half of this fiscal. If you look at our 5 portfolios across alternate platform, which is PMS and AIF, all the 5 have generated at least 12 to 20% earnings growth. So see, as a fund manager, as an investment team, we can have certain logic to what we are doing in terms of our research. So our ability to understand a company is better, but at the same time, we can only say how much earnings growth will come in. We can't decide what the market will give in terms of multiple. So we are cognizant of the fact that despite the first half being quite bad for the market, I'm talking about the broader markets, the earnings growth has been tepid. For our portfolios, the earnings growth has been anywhere between 15 to 25%, depending on which category and which fund you are talking about, right? So as a fund manager, if I am confident on my earnings growth profile of my portfolio, eventually that kind of return will be generated to the investor. So you have a portfolio where the earnings profile is 20% plus, beta is lower, Sharpe ratio is better. I mean, this could be a very balancing act when you look at, giving recommendations to your clients. So I will give you just one example. This is the disclaimer is this is not a recommendation. This is what we have done today. Also, Artemis is one of our top holdings in our PMSs across PGIM Alternates. I will give you my logic. All the GAN which I gave you now about process and all, it fits this bill, right? Today, if you look at when we entered Artemis, the market cap was hardly 1,000 crores, right? But the beauty was that time this is a standalone hospital in Gurgaon owned by Apollo Tyres Management. They had 400 beds occupied, or let's say the capacity was 450 beds. This I'm talking about 2 years back. That time when we analyzed the annual report, when we went through the balance sheet, when we did our research, and we also went and met the management, we got a sense that that 450 bed capacity is going to go to 700 beds over next 2 years, right? Now, see, it's a very simple example of operating leverage. Hospital में क्या होता है? Hospital में lot of your doctors, nurses are fixed, right? So your cost structure is quite fixed. The moment you add, now they were adding more than 50% capacity. From 450 beds, they were going to 700 beds, right? So that's 50% plus kind of capacity. The moment you do so, and they had a good cash flows on the books. So the moment you do that kind of a framework, now fast forward to 2025, now their revenue growth is 15-20% because the new capacity has come in. The fixed cost structure is fixed, and this company now is compounding at 35-40%. So classic case of operating leverage, where we thought about the gross block, we looked at how many beds they have. From 450, they were going to 700. That time the market cap was 950 crores. Today the stock would have gone up 3-4x. The point is that if your research, if your framework is right, then these kind of multi-baggers, even in today's market where a lot of froth is there in terms of valuation, are still available. So it was more of an example rather than any recommendation here. So this was about my process. Quickly, PGIM. So many of you might not be aware, you might be confused that we are part of Prudential, but Prudential UK is the one which has a tie-up with ICICI. We are Prudential US. So PGIM actually stands for Prudential Global Investment Managers. The fact is, Prudential UK has this thing to use Prudential as a name. Hence, we can't use Prudential. But globally, Prudential US is the 11th largest asset manager. Second, in terms of alternates, we are the 4th largest globally. And the good part is, and which we are very proud of, 90% of our funds globally also are actively managed. And we believe that active management will give you a lot of alpha generation. So we still believe it's a human business. End of the day, it's our ability and our knowledge which comes into, building the portfolio. So this was about PGIM. Lastly, on our funds. So as I was telling you, when you look at ROE, ROC, right? You look at our AIF1, which is a long only Cat 3 portfolio. The ROC of the portfolio as of last month is 20.47. The ROE is 15%, right? Again, as I was highlighting, the beta of the portfolio is 0.7. And if you look at the Sharpe ratio, it's much better than the broader indices, which is Nifty 500. So with this, I will conclude here. Thank you so much for your patient listening. And thanks you once again for coming on a Sunday afternoon and listening to all the GAN. Thank you so much.
Thank you so much, Surrjit sir, for thinking us beyond ordinary and also talking about risk, which is equally important to return. I would request Mr. Vyas to please come on the stage and present the token of appreciation to Surjit sir.